Aloha and welcome to the Sylvan Bell Business Growth and Exit Strategy Podcast, your guide to building companies that command maximum multiples. I'm Sylvan Bell, author of 5 books on business strategy and sales, creator of the Sell Framework, Scale Framework, and Driver Test. I work with owners of $10 million to $250 million companies, whether you're scaling for growth or positioning for a profitable exit. Each episode breaks down one framework, strategy, or concept you can apply this week to grow revenue systematically, scale operations, and maximize enterprise value. Let's get started. And we're here for episode number 2, the difference between revenue growth and enterprise value creation. And it's something that is very important when it comes to growing your business to sell for that amazing exit. And revenue growth can go up while enterprise value goes down. And it's the belief that a lot of founders, owners, and CEOs have that, hey, if I just get to this magic number, if I could just get to 5 million in rev, if I could just get to 10 million in rev, if I could just get to 20 million in rev, I can exit this thing for massive multiples. And that's not the truth. So when you treat the revenue as the scoreboard, the buyers look at it and they say, hey, listen, we've got some problems here. We've got some issues. Yeah, you were able to get rev. You were able to go to the bar and brag to the buddies. You were able to go to the meeting and tell everybody, hey, here's how much revenue we've had. But how much did you keep? How much stayed as profits? And when you start thinking in terms of, okay, if I'm going to get a multiple, I'm going to be paid on profit. The real brag is I had a $10 million company with a 25, 30, or 40% profit margin. That's where the real brag is. Somebody who goes and brags to people, hey, I've got a $100 million company and they made $1 million in profit. That's nothing to brag about. Growth that looks impressive doesn't transfer in underwriting. So what you'll find is there's going to be somebody who takes a look at your books, and they're probably going to be a younger fellow or person from an Ivy League college, and they're really good at Excel. They're really good at looking at the books. And they go through them fine-tooth comb. And that's what their role, that's what their function is. Their job is to validate facts. And the feelings don't fit inside of an Excel file. Like they'll look and they'll like, nope, they're not there today. What they're looking for is the facts of your business. What are the numbers? What's the scorecard that investors look at is completely different than just looking at the vanity metric of this is what we did last year. Price is a function of durability, confidence, not effort. Can we do it again? Can we go back and can we make magic happen again? Can we had a $10 million year last year. Can we have a $12 million this year? Can we have a $20 million last year? Can we do $25 million this year? What you're looking for is that predictability where you're somewhat or amazingly growing the business and magic is happening. One of the problems that I see is founder dependence, where everything has to go through the owner, everything has to go through the founder, everything has to go through the CEO, and there's no layer of management. There's no decision making outside of the main person who owns and runs the company. And when you have dependence that's that much, when that person leaves, when you leave, what's going to happen is they're going to say, okay, we're going to have to fill that role. So we were going to fill it anyway, but we're going to have to find somebody who's going to have to bring a new management team in or bring the old management team up to speed. And by the way, we're going to discount because of that. And by the way, when we take a look at it, we might have a little bit more of a holdback. We might say, we were going to give you $5 million, but we're going to give you $1 million and hold back $1 million in a basket. That's one of the ways that somebody may refer to a holdback, is they might call it a basket. How you earn it, the quality of your earnings matters as much as how much you earn. So when you take a look at how did you get there, the question is, who helped you? Was it systems and documented processes that got there? Was there 1 or 2 people that are magical on your team? Is your team magical when it comes to producing revenue and producing profits? Quick break and message from your sponsor, Sylvan Bell. That's me. If you're getting value from this episode, here's how to go deeper. First, subscribe to my weekly newsletter, The Party, at scottsylvanbell.com. That's where I share the strategies, frameworks, and case studies I don't release anywhere else. You'll get one actionable insight every week you can implement inside your business immediately. Second, while you're on the site, download the complete Sell Framework, Scale Framework, and Drivers Test. all free with scoring guides, worksheets, and step-by-step implementation checklists. These are the same frameworks I use with $10 million to $250 million companies to build systematic revenue, scale operations, and maximize enterprise value. Go to scottsylvanbell.com right now, subscribe to the newsletter, grab the frameworks, and let's keep building companies that command maximum multiples. Let's get going. One of the items that people talk about when they come to purchase your company is a hot streak, like a heater, as they call it in Vegas, is not the same thing as bankable profit. Predictability. Like if there was a magic word for today we talk about a lot of magical things, but if there was a magical word for today, it would be predictability. How do you make your business predictable? And that is one of the things that compounds valuation. The clearer the forward view that the buyer or the investor has, the less they have to guess. What happens is in really large firms, you have salespeople that'll go out and they farm leads. So they'll meet with owners and say, hey, what's your time horizon for selling? And somebody may say like 3 years. And they go, okay, well, give us your financials. And then they have a war room set up. And then what they do is they rank the companies and they say, okay, well, we've got this company in Florida. We've got this company in Texas. We've got this company in California, whatever state, whatever region. And then they rank and they say strategically, who is the best chance or the best opportunity for us to buy based upon what we're trying to achieve. And if they're breaking into a market, they're looking for all this list. They're looking for saying, hey, we can take this and run. We have a platform business. And a platform business means that they're going to purchase, hopefully your business, and then they're going to do bolt-ons. They're going to find smaller companies to bring under the brand or the name. And that has value. When you're looking to sell your business, and if it's a big type of franchise company, if it's home services, what those companies are looking for is a platform. They're looking for, in this region, we could purchase this company and we can bolt on a couple more companies, and we could take this 5, 10, 15, $20 million company to 100 or 200 million just by putting everything else under one brand. And they'll pay extra. When somebody's saying, hey, I want to buy a platform company, this is where the magic multiple comes in, where they say, we're going to pay extra for your company because of the name, because of the reputation, because of the reviews, because of the systems, because of the processes. The processes and cadence turn performance into something that the new owner can run. We're talking ease of operation, turnkey. The easier it is for somebody to walk in, if you walk out tomorrow, the better off that you're going to be. What you want to do is you want to stop chasing more. The vanity metric of more revenue, and what you want to do is start building repeatable and transferable actions inside of your business. And what you're going to find is it stabilizes. It stabilizes the growth. It stabilizes the activity. And as investors start coming in, looking in, they start salivating, because you went from a possibility to like, we really want this company. This is everything that we hope for and dream. I use a grading when it comes to investing in a company. A+ is the dream. That as an investor, you look at it, there's standard operating procedures in place, the team is in place, it's profitable, it's turnkey, the owner can walk away and here you go, the business can run. A- means there's a little bit of work that needs to be done, some bumps and bruises over here. A is, okay, now there's a little bit more work. B is, we're probably going to have to find a manager to run or an operator to run this business. C is for chaos. Right? There's just chaos inside. And for every level that you go down, there's a deduction in your valuation. A+ means you're going to get above market. A means you're going to get at market. A-, a little bit less than market. And then B is probably a 10% discount. C is a 30. And then really anything below that, you're looking at a 50%, maybe, if you're lucky. I did some consulting today, and one of the conversations that we had was about the business was sad because they had no enterprise value, meaning there was nothing for them to sell. It was a small book of business. They thought they were going to get X amount of dollars. And when it came down to it, they really weren't going to get very much. And what they had planned on living on completely changed. And the conversation was tense because, they're expecting a huge amount of money. And then my team did the math and we come back and we said, hey, time out. There's not much here. We're not trying to be mean. We'll show you the math. We'll show you how we got to what we did. We'll show you the risk. And they're now probably 3 years out from getting things settled and selling, and they were hoping to retire this year. So you want to replace growth goals with value drivers. You want risk reduction. You want proof. You want transferability. You want standard operating procedures. You want org charts. Like, you're going to hear a lot about this in my podcast. Standard operating procedures, job titles, job descriptions, org charts. These are the bare minimum. So if you're like, hey, Scott, what's the bare minimum? I just shared it with you. SOPs, org charts, job descriptions, job titles. That's the bare minimum. And the thing is you're going to find that the people in your organization in the very beginning may fight against this because they're like, okay, wait, you're putting order in place. What's next? A scorecard? And the answer is yes, absolutely. The next thing is a scorecard. So if you stepped away for 30 days, would the revenue sustain or would it stall? That's the transferability test. That's the, hey, can I go away? Can I take a vacation? And if you can't, then you really start taking a look is what's going to need to be done, what would need to be true for you to be able to take some time off. So pick one initiative over the next 90 days. Take a quarter of time. And the mistake is to think, okay, well, it's a February. I'm going to wait till April. No, it doesn't have to be a calendar 90 days. It can be 90 days from today. It could be 90 days from tomorrow. It's really weird talking with professionals, talking with salespeople when you talk about goals. If people have a bad first month of the year, whether it's sales or whether it's business, I'm like, well, there's always next year. What do you mean? There's 11 more months. The year starts tomorrow. It doesn't mean calendar year. It doesn't mean calendar month. You have the opportunity to say starting tomorrow. It's the first of the first week. It's Monday. We're going to start on Monday, or tomorrow's Tuesday. We're going to start on Tuesday. When it comes down to it, you want to improve predictability or transferability, not just top line growth. So appreciative that you checked out the second episode here of the Scott Sylvan Bell Business and Exit Growth Strategies podcast. Mahalo for listening to the Scott Sylvan Bell Business Growth and Exit Strategy podcast. Here's what's available to you right now. First, subscribe to this podcast so you get every framework we release. Second, visit scottsylvanbell.com to access the Sell Framework, Scale Framework, and Driver Test. All free with complete scoring guides and implementation worksheets. Third, subscribe to my weekly newsletter, The Party, where I break down strategies and frameworks you won't find anywhere else with one actionable insight every week. Go to scottsylvanbell.com and enter your email. And if this episode added value, share it with another business owner building a $10 million to $250 million company. Until next time, keep building companies that command maximum multiples. Aloha.